right, y'all. Good afternoon. Good afternoon. What's going on? What's going on, everybody? You know what time it is. My live at 5. And I got some good information I want to share with you today. Okay, y'all. All right. I'm gonna go ahead and get started. I don't do this a whole lot when I go Facebook Live, but I think it's all right. It says live, and I'm sharing my screen. But I want to get into a very hot topic tonight, and that is, do we really own our tax qualified plans? Whose money is it, yours or the government? That's my topic today, and I want to share that today. But before I do that, as you know, I always do, I like to have a couple of announcements tonight at 7 o'clock. We have two dynamic young ladies who are going to be presenting the American Classic Agency Opportunity Session. And that's tonight at 7 o'clock. We have Carmen Bernard, based out of Atlanta, Georgia, phenomenal businesswoman. And then here in Maryland, we have Saran Baker, phenomenal businesswoman, high-level executive in district government, just does a phenomenal job. So if you're really open to have a nice, real, serious, legitimate business opportunity where you can make an abundance of money by helping other people, I strongly encourage you to direct message me to get on this call. I want to hear from somebody. I guess I can do this. Can you see my screen? I want to make sure you can see my screen. Many different questions about, my retirement plan at work and all this kind of stuff. And so many people are feeding the government. And what I mean by that is we are funding our retirement by pouring our money in tax qualified plans at work. And I understand, a lot of times, if it wasn't for tax qualified plans at work, most Americans wouldn't save at all. Right. So I want us to understand today exactly how tax qualified plans really work, and how you see them and how the government sees them. And then you got to sit back and realize who's in control. From what I know, the government tells you based on your age, how much you can put into your retirement plan at work. I mean, if y'all know, if you're 50 and over, y'all can put in almost 25,000. For those of us that's 50 and younger, you could put in about 19,000 or so. But the government tells us, think about that for a minute, how much you can put in your retirement plan at work. Does that really seem fair? But people do it because that's what everybody else is doing. But if you really want to be wealthy, you got to do what the wealthy people are doing. So let's look at really what the tax qualified plans, how do they work? How you may see your program, a place to save today without paying taxes today. That's how the average person sees it, right? But the money in your account is yours. That's how you see it, because you get a statement with your name on the letterhead and you think it's all yours, but guess what? Here's how the IRS sees your plan. A place to tax you in the future. The government is broke, y'all. We got to understand that. Trillions and trillions of dollars in debt and growing. Well, how else does the IRS see your plan? The money in the account is yours and theirs, right? Think about it. When we're saving money in these accounts, that money has not been taxed, y'all. So the money is not all yours. We got to realize we're going to have to share that. Qualified plans do two things. Number one, they defer the tax. They also defer the tax calculation. So we don't know how much it's going to be. Isn't that scary? That's just like getting a 30-year mortgage. And it says your loan is for $500,000, but you just make payments. And at the end of the loan, we're going to tell you how much the interest rate is. That's the same thing when we pour our money in tax qualified plans. If you don't know what that means, 401k, 403b, thrift savings program, 457, your IRAs, the alphabet soup. This is really what goes on, right? They postpone the tax. They postpone the tax qualification. Postpone means I'm going to do it later. And when we are doing it later, we're doing it on a bigger pot of money. So for us country folks, we got to ask ourselves, do I want to pay taxes on the seed or the harvest? That's really what we're asking. And most people tell me to see, but their actions tell me, nope, I want to pay taxes on the harvest because we're being taxed on lower income in 2021, 2022, or whatever the year is. But where are taxes going to be when it's time to take this money out? So who's in control? Whose plan is it really? Is it yours or the government's? Remember this, that they're going to tax you 10% if you touch it early. You got limited access to this money before 59 and a half or during your working years. If you work in the federal government, I mean, it's really all yours. The same thing with the tax qualified plan is yours and your spouse's. You can't do anything unless your spouse approves it. So who's in control? You or the government? And at 72, you must take money out. So if future rates are lower, you will have more, right? But think about it. For those of us that live in the DMV, how many people do we know that work in the government or government contractor 30 years, they come out and start their own business, go back and get contracted with the government? Are they in a lower tax bracket? No, right? If your house may be paid off, you don't have that tax write-off because we helped you get out of debt. That's one of the things we do. If you're watching this and you're one of our clients, we have a client appreciation night, Monday night at 7 o'clock. Direct message me for the details on that. You don't want to miss that. Your children are grown now. They might be still living with you, but you can't write them off anymore. You're not working now, so you don't have that deduction that you used to have when you were contributing to a tax qualified plan at work. And the soup kitchen that you used to contribute to, now that you're on a fixed income, you don't do that anymore. So we don't have all the write-offs. So a lot of times we're not in the lower tax bracket. So if future tax rates are higher, you will have less. Now, who do you think is going to pay for this coronavirus relief stuff and all that kind of stuff? The people that are that understand that they're going to earn it, the people that don't are going to pay it, right? You've heard me say this time and time again that all that money is not yours, but sometimes it doesn't sink in until you actually see your particular situation. So I hear people all the time, Anthony, I'm good. I have a 401k or TSP at work and whatever the case is, right? And I always ask them, what tax bracket are you in? There are a lot of people in the DMV that are in the 30, 35, 37% tax bracket, both husband and wife, both been in the government contracting, both making over $150,000 a year. They're in a high 30% tax bracket. They got $2 million in their tax qualified plan at work, right? That's the statement that they got. And they tell me this is what I have, right? And I say, well, not quite so, because that money has not been taxed yet. So if you got $2 million and your tax qualified plan at work, and you're in a 33% tax bracket, you only have 1.3 million. The other $660,000 is going back to the IRS. I didn't make this up. This is what goes on. So again, who's in control, right? And if you keep contributing to the tax qualified plan at work, normally as you work, your income goes up. You get in the highest tax bracket when you get closer to retirement because you're earning the most money now. Well, look what happens. You got 1.2 million that's actually yours, and the other 720,000 is gone back to the government, the IRS. So people ask, well, Anthony, how can I avoid this? I say, quit pouring your money into an account that you have to share with the government. Cash value insurance is an account that you don't have to share with the government. If you structure it properly, you can have an abundance amount of income coming in. It doesn't matter what your tax bracket is. It doesn't matter how much money you make. You are not limited as to how much you can put in. In most states, it's creditor protected. So you just got to get with the right team. And those of us at American Classic Agency, we are masters at designing products like this, where you could have an income stream that you could never outlive that's coming in for the rest of your life on a tax-free basis. You can create your own private banking system using this concept. I don't know about you. I don't want to give the government $720,000 unnecessarily. But guess what? If we don't make changes, it's going to get worse. Why? Because we are steadily going into debt. When you get a chance, Google usdebtclock.org. I'm going to pull it up for you. This is real time. You see this at the top? It says real time. Look at this. That means we are constantly going into debt by the seconds. The average taxpayer is going to pay $242,000. So out of every 76 cents, out of every dollar that the government makes, 76 cents is going on Medicare and Medicaid, Social Security, interest on the debt. And then we got to think about protection of our country. That's a lot of money that's going out and steady growing. So the bottom line is the government has made resources available to us. You just have to know what they are, right? And I'm going to share with you what they are, right? We got to get on board with this stuff. You probably can't see this as well, but I'm going to share it to you. Anyway, the Tax Equity Fiscal Responsibility Act of 1982, Congress provided a mechanism for insurance for special tax treatment, cash value insurance. They modified the laws in 1984 called the Deficit Reduction Act. I'll call these the three sisters. Now you see why the wealthy people pay less tax than middle class, because they understand taxes. But the third sister was born, the Technical Miscellaneous Revenue Act of 1988. It talks about the proper funding of it and make sure you don't put in too much too early, but you got to get with the right agent. We are trained here at the American Classic Agency. We can show you how to do it. It's nothing but a tax code. 7702A is the biggest tax advantage in Internal Revenue Service Code. You just can't go call somebody that's in the industry and get them to do this for you. It has to be someone that specializes in this. Give us a call at 301-794-4290, and we'd be more than happy to show you how to properly set this up. But not only are the wealthy people doing it, banks are doing it also. Look at Bank of America, $9.8 billion in real estate, $3 billion in stock, but $20 billion in cash value insurance. They know something. The wealthy people know something. The banks know something that middle America needs to know. But they're not the only ones. If you look at a Facebook post from Lena Numwaya, it listed all of the banks that's doing this. The highest ones, Wells Fargo, $8.3 billion in real estate, $500 million in stocks, almost $20 billion in cash value insurance. And I know there's people out there that saying buy a term, invest a different. That formula has not worked for middle America. The wealthy people understand it. The banks understand it. So ladies and gentlemen, little old you and I got to understand it as well. So if you want to learn how to set up this strategy, and you can use this strategy for debt elimination, for tax-free retirement planning, for sending your kids to school instead of using the 529 plan, you can use it all here, right? So you just got to know how to do it. So who's in control of your plan? It sounds like to me, the government is more in control than you are, because they tell you when you can touch it. They tell you how much money you could put into it. They tell you at 72 years old when you must start taking money out of these tax qualified plans or your IRAs at work. In cash value insurance, you control it. It doesn't matter your income. You can put in as much as you want as long as you structure it properly. You don't have to ask for why you need to go in and take loans against it for other opportunities. It's nothing but a parking garage to park money for opportunities that you come across, like buying real estate, buying a new car, buying a new home. So ladies and gentlemen, we got to get on board. You have to be in control of your plan. You work for it. You should control it. So again, I want to thank you today. This is Disability Awareness Month. Next Tuesday's session is either going to be a disability session to talk about why we need to protect our income. All right. Thank you all for joining me today. And I'll talk to you next week. Bye-bye.